Hello, everyone, and welcome to session 2 of our virtual Marine Money Hong Kong Ship Finance Forum. Although we would have loved to be in Hong Kong and to be seeing you all in person, in times like these, we have no other choice but to resume our networking and intelligence sharing online. I am your host, Andrew Oates. This session will focus on container shipping, shifting trade patterns, operational efficiencies, and access to finance. And we will hear the thoughts from 4 of Hong Kong's largest and most active ship owners on their market outlook for 2021. To begin session 2, I have the privilege to introduce our presenter, Mr. Parash Jain, who will deliver a presentation titled Container Shipping, Moving On from Its Lost Decade. Parash is the Global Head of Shipping and Ports Equity Research and the Head of Transport Research of Asia Pacific at HSBC. Based in Hong Kong, Parash covers the Asia marine sector, including logistics, and is responsible for developing regional and global products in conjunction with other transport analysts. So to begin the presentation, Parash. Parash?
Yes, sure. Thank you, Andrew, and thank you to Kevin as well for inviting me to share HSBC's view on container shipping. And needless to say that it's a pretty interesting last couple of quarters. Even before COVID-19, this sector was dealing with the buzzword called IMO 2020. So I prepared a few slides, which probably Andrew will be able to put it up as we speak. So over the next perhaps 10 to 15 minutes, I will share my view on the sector, but most importantly, I will try to address one of the key questions that I have been asked very frequently by our investors. So maybe Andrew, if you can go to slide 2. So what I'll be focusing for the next few minutes would be to compare this crisis or the opportunity in crisis versus the previous last downturn that we have witnessed during global financial crisis in 2008 and 9. And over the next few slides, I'll try to compare and contrast the previous crisis and the upcycle subsequent to that to what we are witnessing now. Looking at several parameters that you can see on this slide, we will look at how the market share has changed, how the new building orders have changed, but not only that, how that looks in the context of demand, and moving on to what are some of the key emerging trends that we are witnessing. And if you see at the last part of the chart, you will not be surprised that intra-Asia slowly but surely continued to gain larger share of the pie, which is rather growing at a slower pace. So on that note, let me quickly move to slide 4. So I'm sure most of you are familiar with this slide and have seen it in one shape or form. But what this slide suggests is that the industry was fragmented and perhaps is fragmented, but in the wide spectrum of fragmentation, industry is gradually moving towards consolidation. And that we have seen over the last few years. We have seen the top shipping lines have entered into mergers and acquisitions, and we have seen few casualties. So for instance, Maersk has acquired Hamburg Süd, COSCO has taken this fleet from China Shipping and also acquired Hong Kong's very own Orient Overseas, and Michael is on the panel as well, probably share his thoughts probably on this space in a couple of minutes. So what this chart suggests is that this may not be a perfect consolidation, but perhaps give enough confidence that industry is gradually moving in the right direction so far as concentration is concerned. It may or may not be good for the consumers, but from the investors' perspective, this is probably one of the positive signs that ship owners and perhaps investors do focus on. So we are now at 64-65% level. The question comes that will we see more consolidation? And never say never, but cross-border consolidation often stumble with a lot of challenges. So it's very difficult to say if we see any large-scale consolidation in the very near term. But as the industry progress, you cannot deny the fact that we may see further consolidation, if not horizontally, certainly vertically. But at the same time, we have seen how the big container shipping line also formed ultra large alliances. While it is different from mergers and acquisitions, but what alliances has done is to ensure that the excess cost has been taken out from the system, and you can say it's a cost side mergers and acquisitions. There is one section who has the view that in fact alliances has rather delayed the consolidation in the sector, because alliances allowed relatively smaller or weaker player to remain in the game. While it is certainly positive for the consumers, because we have seen that the prices in this space has been deflationary, but it did not allow the investors to generate a sustainable return. So after looking at this trend, maybe if you can move to the next slide. Another key difference between this cycle and the cycle that we have seen in 2008 and 9, and why probably this also gives me the confidence that perhaps the next decade unlikely to be as tough as the past decade. So if you look at this chart, and if you look at the bar on the extreme left, the red bar tells you what was the order book back in 2008 and 9, and the gray small bar suggests what is the current order book. There are multiple reasons why we have come this far from 61 to 9%. Needless to say that growth expectation has reset to a lower level, but at the same time we have not seen a supernormal return in this industry, which probably have discouraged a number of ship owners and ship operators to go ahead and order a new wave of ships. And last but not the least, the decarbonization is making an inroad with successful IMO 2020 implementation. There is no right solution to tackle decarbonization, which ultimate goal is to reduce the carbon intake by 50% come 2050. But with a life cycle of 25 to 30 years, this is about the time that industry need to scratch their head to find a right solution. And the response is not entirely the responsibility of shipping community. We need shipyards to come onto it. We need the banks to come onto it. We need refiners to come out with the right type of solution. So put these together, perhaps the last 10 years of low ordering, few good years of demand, some scrapping, but more importantly, slow steaming has allowed us to get to a level where we are seeing now the order book remains at 9%. Needless to say that large part of the ordering is concentrated on the larger vessel category. But interestingly, in and around Panamax vessel sizes, we have virtually no new order, which is 3,000 to 8,000 TEU category. So on this, we can move to the next slide. And as we all know, right, when it comes to shipping or shipping's profitability, supply in isolation perhaps doesn't give you the full picture, neither does demand. So this is one of my favorite chart. It's a busy chart, but let me walk you through. What the left-hand side chart tells you is what was the peak capacity in 2008 and 9 when the crisis hit the sector, and what was that order book representing with respect to industry's expectation of future years of demand and scrapping, for which essentially you need to order ship. And it suggests that optimism was so high that the order book was covering more than 5 years worth of demand and scrapping or renewal of fleet. Fast forward, this number stands at below 2 times, with the new ordering at a multi-decade low of 9%, based on last few years of average demand and scrapping, it suggests that this order book will not be sufficient even for 2 years, all else being equal. And a pretty much similar sort of trend you can see in dry bulk, tankers, crude and product both. And the panelists who will join after this presentation probably will be able to share more light if it remains relevant. And on keeping on the same order book dynamics, if you go to the next slide, which further reinforces our view that why next decade is unlikely to be as tough as last decade. So not only that the order book remains 9%, but as much as 6% of existing fleet are older than 20 years. It's pretty much safe to assume that these older vessels are unlikely to have installed scrubbers, and therefore as and when the freight rate declines or reach to a level where the industry is not making money in aggregate, you will see an acceleration in scrapping of these segment of vessels, and which therefore will very quickly bring the demand and supply into equilibrium, which has not been the case subsequent to the last crisis, because the order book was so huge that any amount of scrapping would not have been enough to bring demand and supply to the parity. And you can see in different vessel sizes, but the crux is that this time around, if you think of an order book, 2/3 of that order book over the next 2 to 3 years perhaps will only cater to replenishment of fleet rather than new demand. And that brings me to the next slide, where one after that, where I'll touch upon the trade growth. As I mentioned, that the decline in order book is not in isolation. It is pretty much a reflection of ultra high single digit or double digit days of the trade growths are over. However, if we run through this cycle over cycle, it is fair to say that expecting container trade growth maybe around 0 to 100 basis point higher than global GDP growth is not necessarily an unrealistic assumptions. While one can argue that the outsourcing or the long haul trade may have seen its peak, but I'm of the firm view that with China's deliberate attempt to move its low-end manufacturing out of China, but the cost economics suggests that they are unlikely to return back to the US or Europe, means that low-end manufacturing is finding home in Southeast Asia and increasingly in South Asia. But what is important to note here is that this process will rather lengthen the movement of semi-finished goods between China and the rest of Asia, because the core competence or dominance of China is unlikely to be shaken with this migration. I'll give you an anecdote. 20 years back, when China started to move in with respect to become a manufacturing hub, for every $1 of export, China needed to import 2/3 of the goods or raw material. But over the last decades, China became self-sufficient and created a powerhouse of supply chain. Today, for every $1 of export, China only import 1/3. And that's one reason why we have seen this multiplier also shrinking. So intra-Asia potentially remains a place where you may see trade growth rather accelerating the global GDP growth because of a more and more semi-finished goods trade between China and the rest of the region. That brings me to the next slide, which focuses more on the short term, and I'm sure everybody has seen this, but this is pretty much comparing this downturn compared to the one again in 2008 and 9, and it's suffice to say now that 2020's container volume decline is now unlikely to be as bad as it was feared a couple of months back, or as it was the case back in 2009. Moving on to the next few slides, which pretty much explains what we discussed so far has resulted into the freight rates. and it suggests a quite different picture compared to what had happened in 2008 and 9. The volatility in the freight rate has reduced, and freight rate has rather rebounded much sooner. And there were a couple of reasons probably why freight rate to start with will remain at a resilient level. So towards the end of last year, once it was certain, or once it was expected that the IMO 2020 will result into increase in the clean fuel prices, shipping lines went to their customers and convinced them about the increase in cost is for real, and most of the customers have accepted that surcharge. So you entered into 2020 with a freight rate which reflected the surcharge, and as soon as the crisis hit, unlike previous crisis where in 2008 and 9 container shipping industry faced this crisis after a few real good years of making money, this time around this industry entered into this unknown with a lost decade in terms of making a sustainable return in aggregate. Few companies did make, but in aggregate for the sector it were not a great decade. So they were very quick to adjust their supply to cater to the demand, and we have seen an unprecedented level of blank sailing, we have seen a bit of slow steaming, we have seen an idling, and freight rate found its feet. Soon after that, come end of May, as the economy start to reopen, or some of the major economies started to reopen, we have seen a bit of pent-up demand. But as we move from second quarter to third quarter, the pent-up demand has now taken a shape of restocking cycle. So we have seen that the importers in the US and Europe is now scrambling to get as many goods as possible and try to create a buffer for any unforeseen lockdowns if they may come across. And that brings me to the last few slides, which is on the freight rate that I have already discussed. So maybe we can skip this and go to the final slide where I'll summarize my view. While it is often says that it's hard to quit old habits, I won't say necessarily a bad habit. A couple of quarters of profit historically has led shipping lines to perhaps jump into ordering new vessels, and that lead to price war. I don't think that this time around, with the concern of decarbonization, with the uncertainty around the demand outlook and geopolitical issues, I do not think that container shipping industry will get equally excited and go ahead and order a plethora of ships. And that brings us to a decade where probably demand and supply will remain pretty much balanced, and time to time you will see one exceeding the other, but which will mean more sustainable profitability in the coming years than what we have seen in the past. And on that high note, probably I will try to end my presentation. Thank you very much again, Marine Money, Kevin and Andrew, and I'll stop here. I don't think there are room for any questions, but I'll wait to hear from Andrew.